Well, in an uncommon night's trading, at least lately, US markets fell. We saw pressure on the major indices. The Nasdaq led the US share markets lower, but the S&P 500 and Dow Jones Industrial Average also finished in the red. And the pressure that we saw hit some of the most popular stocks. The big tech stocks in particular were under pressure last night. Nvidia down 2.8%, Oracle down more than 4%, Amazon down 3%. So it did look like a real trimming of the sales in overnight trading. And one of the key reasons for it was a speech by Jerome Powell, the chair of the US Federal Reserve. Mr. Powell said that the Fed was balancing two risks. That is the risk of increasing unemployment and the risk of increasing inflation. Now, this should not come as a surprise to the market. This is the Fed's mandate after all. It's often referred to as the dual mandate. And these are the two key parts of the US economy that the Fed manages via its interest rate and broader monetary policy. So this shouldn't have come as a surprise, but there was a market reaction. And the reason for that was Mr. Powell's speech was quite balanced. And the market is not. The market is aggressively pricing rate cuts into the future, with some analysts predicting as many as 5 rate cuts over the coming 12-month period. And that aggressive dovishness, which seems like a contradiction in terms, has been factored into the share market. So as soon as there was a slight stepping away from the most extreme rate cutting scenarios, the US share market fell. And that is a warning sign to investors. This extreme sensitivity comes about because at the moment, the US markets are pricing perfection. They're pricing a moderate growth to good growth environment with inflation contained and unemployment, any increase in unemployment likely to bring easier monetary conditions. As well as that, they're pricing an AI revolution that's going to deliver hundreds of billions of dollars, if not trillions, to the bottom line of several companies. Now, all of this may come to fruition, but everything will have to pan out perfectly for that to happen. And in that sort of scenario, any missteps could see a severe market reaction. Last night's market reaction was not so severe, and yet the trigger for it was minute. So something for investors to be aware of, given the sensitivity that was displayed to a very minor shift in the Fed's stance, or at least the market thinking about the Fed's stance last night. Big event today is the Australian CPI, coming at a very febrile time when it comes to thinking about central bank actions. This is only the monthly read. The quarterly read we know is more influential, but even so, at this stage, the monthly read is expected to show a tick up from 2.8% in the previous month to 2.9% last month. Some analysts are pushing towards the 3.0% mark. Now, this would be concerning. Anything above 3 could see a market reaction. It could spark selling, particularly given the atmosphere and the events in overnight trading. A lower number, though, could bring real confidence. And given that the Australian share market has underperformed the US over the last 6 or 7 trading days, a low reading on monthly inflation might be enough to see the Australian market play catch-up in trading today. One of the sectors that is of note at the moment is the retail sector in Australia. Now, the sector as a whole, if we look at retail, is up 25% year to date. Most stocks have performed very strongly. We've seen big players like Wesfarmers, JB Hi-Fi, Harvey Norman, all showing strong growth in their bottom line and in their share price. However, it's not all good news, and some stocks remain under severe pressure. So far, year to date, Michael Hill is down 42%. The jewellery group really suffering at the moment, whereas a group like Lovisa, who are selling low-end jewellery, are up 32%. Yesterday, we saw some enormous swings. Cettire, the luxury goods retailer, was up 19%, whereas Myer was down 25% over 2 days. So there's a real mixed fortunes in the retail sector. It's not like a lot of the other sectors where, for example, when the gold price goes up, most gold producers go up. We're seeing very different performances based on the individual experiences. Now, the overall result from Myer did suggest that it was a very cautious trading environment over the 24-25 financial year, but the first 3 weeks of the F26 financial year are looking a lot better. And in fact, Myer reported a 3% plus increase in sales for that 3-week period. So the overall outlook might be improving for retail, and that might be a place for traders to be looking. We tend to look to other sectors, particularly day traders, when looking for volatile stocks. I'd like to point out to our clients that retail has joined that cohort. And one of the biggest of them recently has been that Myer. The big profit fall they reported 2 days ago, down 30%, really weighed on the share price. Now, we have seen a small bounce off the lows, and there was some evidence of bargain hunting. Myer has got a strong stable of brands and a very experienced leadership team. And this resetting that we saw at this result, the write-down of 200 plus million and the report on a tough trading environment might have been a clearing of the decks for Myer. Certainly a number of analysts are pointing that way. Morgan Stanley retaining a buy rating on the stock despite lowering its price target to 77 cents. But of course, that looks like a lot better than the current share price. Another stock watching closely at the moment is Micron in the US. The code is MU. Its quarterly revenue jumped 46%. And while it is a chip and cloud-based business, that is very strong growth across the board. 12.5 billion in revenues for the quarter. Shares were up 40% over the past month. So it's not as if this is a complete surprise, but they're up more than 100% year to date. So indicating just how strong that trend towards, artificial intelligence and those whose services is. The biggest demand for Micron could be for its cloud memory offering. This does seem to be where we've seen the greatest evidence of beneficiaries of AI, and given their presence in the space and their long-standing commitment to it, they could well continue to benefit from that anticipated cloud demand. And looking locally again, Drone Shield on Monday morning joined the ASX 200. It was up 7% in trading yesterday, and it is down from its August high, but up 360% year to date, so still doing very well. The announcement that it was looking to double its US workforce to increase its research and development capabilities in the US was seen as very good news for the company. It's very important in the defence space to be in line with governments, and running R&D centres in the US is a very good way to align with the US military. So Drone Shield appearing to be making all the right moves, with a presence now in the US as well as Europe, and of course locally. The overall response to this from analysts has been very positive. There are a number of strong buys on Drone Shield, and it could be one that's taking off very soon.